ROI totally depends on person. It also depends on whether you want cash on cash, whether you're doing cap rate, or as one of my client appreciation. And one of my clients, like I'm always talking cap rates or whatever. He's like, stop saying cap rate. He's like, how many dollars a month am I putting in my wallet?
Yep.
Welcome to the REIPOST.com podcast with your host and co-founders Mike Bazadona and Steve Franco. The REIPOST will be the web's largest resource and marketplace for the real estate investor. Now to the podcast with Mike and Steve.
All right, Steve, our first question of the day is, it's Chris from South Carolina. His question is, should I buy an investment property in an LLC or in my personal name, and why? I feel that it just costs a lot of money to start an LLC, so should I just save the money?
Okay, yeah, this is a good question. It's a common question. Almost always we're getting this from people. And it does seem like, especially if you use a lawyer, which is the recommended way to do it, but some people do it themselves. If you use a lawyer, it's almost always going to be, $500, $1,000, something like that, just to open the LLC. And then there are a lot of rules you've got to keep doing in order to make, keep the LLC active and so forth. So it seems like, oh, gee, why am I going through all this trouble? Why don't I just, do it myself and own it myself? Well, the problem is that you have a lot of risk if it's in your own name. If any business activity is in your own name. My mother was a complete liability freak, and she made me open an LLC when I turned 18. And all of my volunteer work was done in that LLC because under some lightning bolt scenario, something might go wrong and something might come home to me personally. Didn't have a lot of assets, but whatever. And you want to open that LLC, you want to have that protection, not just for the liability, but you also want to have that protection because it is critical to your business to take advantage of the write-offs and so forth that are available in owning and operating an LLC. The reason LLCs were created was to make an easy corporate alternative than running a big company, a sub-S or a sub-C. Sub-S wasn't even around then. And there's lots of write-offs you can get as an LLC you can't get. Home office deductions, things like that. So you definitely want to have an LLC for everything you're doing, even if you're just wholesaling. The best example as to why is whatever goes wrong in your LLC, assuming you don't break the corporate veil, assuming you don't do something really stupid, lives and dies with that LLC. When you sign your name, you are not signing personally, you are signing on behalf of the LLC. I had a 6-unit building. Kid jumped off a 3rd floor balcony. 20-year-old kid, he's going to be in rehab for the rest of his life. It's bad. And had it been a fall, had it been our fault, had it, that company is liable for the rest of that kid's life for keeping him in the rehab facility. It wasn't our fault. He was high, whatever. It's not a big deal. But the difference between LLC and not LLC was my worst case scenario was I would lose the company. They would own the company if it went to lawsuit and it went past insurance and everything possibly went wrong. They take the company. If I'd owned that building in my personal name, Steve Franco owes that family for whatever the judgment is that he says that owes that family for. So $100 million judgment, I'm never beating that. I'm never getting out from under that. That's why you have an LLC. You have an LLC to protect yourself. Also, the write-offs. But you definitely want to have everything in an LLC. Probably longer than you wanted, but that's the general idea.
Yeah. Well, hey, listen, the protection just alone is why you should do it. God forbid, if you had 12 investment properties and they're all under your name and on that one property something happens like it did on you, they could take all your properties.
Yep.
And where you live and your cars, whatever's in your name.
And exactly. And don't do everything. We were very scared at that time because we owned 28 units, 18 of which were in the same LLC as that building.
Yeah. And I've learned that from you.
To lose 18 units.
I learned that from you, Steve. And I thank you. Each property should have its own LLC.
Each property, or whatever you consider your tolerance for loss. So like for us, it's 3 or 4 properties in LLC. Because if you only own a double worth $50,000, whatever. Mike, I know with one of your properties in Scranton, it's a pretty substantial value property. It should have its own LLC.
Yeah,
because that's more of a loss. You don't want to lose more than just that one if that one has to go away.
Yep.
And it's not that big a deal. Yeah, you pay. Every LLC needs an employer identification number or tax ID number. Every LLC needs a bank account. I've got 9 LLCs, so we write 9 different tax returns every year, and all the company does is own the property. But you know what? Okay, I pay my accountant an extra $900 a year for the extra things. So what? It's just a number on a spreadsheet. It's another tax write-off.
Yep. You're safe and secure. You can sleep at night knowing that somebody can't take all those properties from you because of something stupid they did, not even you.
Yeah.
That kid fell off out the window or whatever it was. I mean, that's sad. But, you could have lost everything and it wasn't even your fault. So.
Exactly. And on top of that, you have to fully insure your building. And people say, well, I only need $50,000. I don't have any property with less than $1 million in liability. And there's $100,000 for something else. I forget what it is. And then I have an umbrella policy on top of that.
Yeah, so do I. And because of you, we have that, we do a $1 million umbrella policy, which is great.
And there was a slip and fall, and I know it was a fraudulent slip and fall at one of my buildings. And I told the insurance company, tell them to shove it up their hoo-ha. Well, they didn't. And 6 years later, the insurance company is still fighting it, and they're going to end up writing the woman a check for $10,000, which is probably less than her lawyer fees, but whatever. And I have had nothing to do with that case. I've spoken to an attorney once. I had one deposition. I don't know what's going on with it because the insurance company takes care of it. Because whatever, and when the situation happened, I called my insurance agent, and he's like, "Are you kidding?" He's like, "They could sue you for." He's like, "You're so covered, it's not going to matter." He's like, "Just go to sleep and forget about it."
Yeah,
it happened.
All because of that umbrella, right?
Well, in this case, because it's so clearly fraudulent. They're talking about $5,000-$6,000. It's not even going to get to the umbrella. But yeah, like if it blew past my $1 million policy, it's going to hit my $1 million umbrella. So it has to pass $2 million in liability before it even starts to bother my company. And in that case, it never will bother me. Because worst case scenario, if 1,000 children were shot dead by the building, it's the company that pays the bill, unless they can prove I was personally negligent.
Mm-hmm.
Other than that, it stops with the LLC. Anyway,
that's about it for Chris's. That's about it for Chris's question here from South Carolina. Okay.
Yep.
So now I'm going to go from Dave from Jersey. He wants to know: should I get a mortgage in my name first and then change the name on the deed to his LLC?
And of course, this is none of us are lawyers. We're not doing this.
Yes, not a lawyer
that way at all. This is personal experience. But my short answer is no, because first of all, in Pennsylvania and many other states, there's something known as transfer tax. Every time you change the name on the deed, you've got a bunch of paperwork to do, not the least of which is paying a 4% or 2% or something percent to the state or the county or whatever entity. And so you buy it in your personal name, and then you pay another $4,000 to switch it to your company name. Well, how much do you really have to save before that $4,000 actually means anything? The second thing is that your bank has, and I'm not saying they'll ever catch you on this, I'm not saying it'll ever become what it could become, but they have your name on the thing, on the paperwork. They have your name, they have your blood type, and you're this and you're that. And if they ever in any way, shape, or form discover that the property is not in the mortgage holder's name, they have the right to trigger, among other things, their due on sale clause, which says when you change the name on the deed, the mortgage comes due and owing. So you have a risk there. You also will have burned a bridge with that lender. And at the end of the day, especially with the phenomenally low some phenomenally low interest rates nowadays, why bother? It's not. Is it really going to save you enough to be sure that is it really going to save you enough that it's worth all the effort and it's worth wondering? It's kind of like now if you're getting 3% on 30-year amortization and you're getting 6% on 15-year amortization and the numbers are substantial, it's certainly something you can try. But then the last reason is liability. And to me, liability, having grown up in a chicken household like I did, is always the biggest reason. If a good attorney is going to look at the history of the deed, and a good attorney is going to see the history of the deed as that property was once in your name, and going to look at the mortgage and say, that mortgage is in your name. Ooh, this person has now done damage to their company. They have pierced the corporate veil. Piercing the corporate veil effectively means you've mixed business and personal in a way that's not allowed. Mm-hmm. You're allowed to personally pay any company bill you want. The company's not allowed to pay any of your personal bills like that. And what you've done is you've just handed the attorney the ability to go to court and say, listen, Your Honor, they've already proven that they're fraudulent previously because they did this. Now let's blow their corporation open and make them liable for all the things that I'm now claiming. Yes. And to me, that risk isn't worth it.
So, Steve, if maybe you know this, so if I got a mortgage in my own personal name, and then I did everything that he wants to do here, switch over to LLC, and then there's an incident at my house.
Yeah.
What is that LLC going to really protect me at this point?
That's exactly the risk. Yeah. Is that you I don't know, because you've in theory pierced the corporate veil, and of course, again, if the insurance company just shuts up and writes the check, no problem.
Yeah, but they just don't want to write checks either. You know that,
But if is the thing.
Yeah.
Well, and of course, insurance companies are weird because they would rather write a check than go to court. But it kind of all depends. And I don't know practically because I know at the time your title attorney kind of guided you on this. I don't know practically whether what I'm afraid of is practically a major issue. But to me, and at the time, I remember with yours, it was a substantial dollar amount. In fact, I think we talked about it. We're like, well, listen, of course you're going to save the money.
Yeah.
It just ensure the living daylights out of everything. But nowadays I just got a 3.75 for my commercial property and 25-year amortization. Why are you even bothering?
Yeah.
Money right now is so cheap.
Cheap. Yeah. Okay, so you're, we're telling Dave probably he should definitely talk to his attorney and his accountant, but
yeah,
I don't see, I wouldn't play that game. I wouldn't take the chance because I feel like we're
no, and
if you're going to have an LLC, then why play games? Don't put it in your name first for everything's a write-off anyway. Write everything off. You'll be fine.
And that is the important thing. That is the first thing to get comfortable in your head. As a person, you are taxed on your gross income. If you make $100,000 a year if your company says it's $100,000 a year, you're taxed on $100,000 a year. I'm being kind of round about it. As a company, except in very few cases, you're taxed on your net. So if you make $100,000 a year and you spend $99,900 in expenses, legitimate expenses, you're only taxed on $100 a year. This is one of the ways that Donald Trump and others can get away with only paying stupid low tax rates. Isn't that they're breaking a rule, it's that they're using the rules. They're living, they have staff that is living their lives to maximize the opportunities. So if you write $500 a year in extra mortgage payments, your company has written that. You didn't write that. And your company gets to deduct that. If you spend an extra $1,000 a year with your accountant by having them handle 10 LLCs instead of one, Yeah, you put $1,000 less in your pocket. On a practical level, dollars are dollars. But on a paperwork level, you're not taxed on it. That money never really happened.
So, you ready to go to the next question, Steve?
Yep.
Okay, this one's from New York, Tatiana. The question is, hey, Mike and Steve, me and my husband saved around $100,000. We like to get into real estate investing, but unfortunately where we live, it takes a lot more to get into the real estate game, and we're only seeing about 2% returns. What options do we have to start to get into real estate investing now with $100,000?
The biggest thing, and of course, we could break this down more specifically as far as which type of real estate investing. But the biggest thing is it's all about what market you choose, and there's a lot of complexities in choosing a market not near you, having to hire management people, harder to keep a bird's eye view on the properties, blah 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 blah. However, that is my first answer to most people. In fact, I hear people with a lot of money. They're buying rentals in LA, they're buying rentals in New York. And even before COVID, which has its own set of problems for those bigger markets, I'm like, why would you buy a rental in New York City if your goal is to eat off the profits every month and make 3% when you can buy in northeastern Pennsylvania, where Mike and I are, and you can make 12, 14, 18, 20%. New York City will appreciate more. It will go up in value. You can refinance, you can sell. There's other reasons to do it. But on a month-over-month basis, if you're looking to make that residual income,
that passive income every month,
2% won't do it, especially when the cost of living increases 3 or 4%. You don't, so I tell everyone, before you spend, before you buy in a market with low cap rate, look at a market like northeastern Pennsylvania that Mike and I can help you find a property in. There's parts of Ohio. There's probably a dozen markets around the country that get really good returns on investments, and or that have lower initial buy-in. In our area, you'll pick up a house for 30, 40, 50,000. You'll throw another 20,000, 30,000 at it, and you'll sell it for 120. On a percentage rate, you're kicking it. You're doing great. On an actual dollar rate, you're probably only putting 10 or 20 grand in your pocket after the flip. And people say, well, why should I bother for 10 or 20 grand? I said, what you have to look at is the ratio.
That's
you
right.
made 10 grand on a total investment of 40, 50, 60, whatever. Yeah, you go to LA, you're going to make $1 million, but your risk, if that deal doesn't work, is huge. In Pennsylvania, I have a client, we did a couple flips a few years ago, business partner. And for whatever reason, we did a dozen of them, and a couple of them didn't sell. So they're rentals. Are we happy with the returns on the rentals? On a dollar value? No. That wasn't our plan. But the building pays for itself, and it throws a couple $100 a month toward us. We refied our way out. We got everything taken care of. And the worst case scenario in Northeast PA is I've got $100,000 on the street that's paying me back slower than I want it to. The worst case scenario in LA is you've got a $3 million mortgage, with all your repair costs, and you can't feed that beast, and you're going to lose that. It's going to hurt your credit and whatever. So that's what I say to people who are wanting to start smaller is find that market that works. And yes, you have to find a manager. You have to find a this. You have to find a that. Yes, there's some complexities. Or switch the gear totally and go private lending. Mike and I can place your money at 10, 12%, and, it returns like that, 8, 10, 12%, all day long backed by real estate. And you have no stress. You never actually own anything. You have a mortgage, or you own the mortgage. You are the bank.
Yeah, at 100%, they're getting, at a 10% return, you're getting about $833 a month.
Something like that, yeah.
Sitting home.
And like I have all of my retirement fund, all of my investable money. I have very little in stocks. I have like $10,000 in stocks. Everything is private lended. And, on the one hand, I'm dealing with a dozen or 2 dozen or whatever it is, stupid $250, $500 checks every month. But you know what? I'm making 12% on my 100 grand loaned out. I put 12,000 a year in my pocket. And what's my effort on that? And if the deal goes bad, the person who's quote unquote owns the house loses everything they have invested in, and I get an asset back that's worth probably twice what I put into it.
Absolutely.
So even if I lose, I win.
Security, Steve. Security. I love it.
That's
You really can't beat
is.
that. Yeah. I tell all my private lenders too, hey, if I go bad on a deal, the property's worth at least double. So you're going to get, so if you put 100,000 in and something happened, I disappeared, you own that property. It's worth about 200,000 at this point.
Yeah.
When I lend money, I always, I don't want them to really go out of business, but if they do, I know I'm going to get my money and then some.
Yep.
But that's just the safety net in it, that's better than insurance.
And also, like we had the gentleman last week, we had that wholesale deal, and his money, he made $1,000 in about a week, which is about whatever 1/30th is in percentage.
1 week.
But his money never left the title company.
Yeah.
He was just backing it. He was just middleman for a deal we had.
Came in. It sat there for 1 week, Steve? And then went back to a $1,000 check. We could do that all day long.
And so that's another angle to play. Private lending is another angle to play. What you can do in a more busy market is you can look at, and this is a lot more work, so you don't need it nearly as much money, is you can find somebody who's going to lose their property to foreclosure or something, or they want it and there's still a mortgage on it. They owe more than it's worth. And you could set up a subject to, where you give them a few $1,000s, you take over payments to the bank, and you find someone to rent that property for more, and you make the spread. So that's another way to get in. I mean, there's lots of ways to get in with little or no money. If you might put $5,000 or $6,000 into a sub 2 deal or something. There's lots of ways to do it, but in most of the markets where it is out of sight, you're not going to find a reasonable subject to either.
Yes, especially they're in New York City.
Usually it's look elsewhere.
Yeah. We're good. You know what, Steve? We're definitely going to reach out to Tatiana, her husband. We're definitely going to reach out to them.
Exactly.
So, you want to go another question? Do we have time for one more?
Yeah, I got whatever time you need.
Okay, good. That's why I love Steve. All right, so we got Mike from Chicago. Mike, that's a great name. He says, how do I evaluate whether a property is a good deal quickly? And how can I also get more in-depth evaluation of a property? And he'd also like to know, what kind of return on investment do you think is worth doing? Do you want me to read that again?
Okay. I think I got it. Just kind of guide me if I miss it. So, okay. So the first thing is, all right. So evaluating a property now, there's two primary types. There's flips and there's rentals. We'll start with flips because they get out of the way fastest. Everyone has now. There are guys who say, "Oh, I'll pay 80% of ARV, and I'll just that's what I do. I buy broken houses at 60% of 70% of ARV. That's what I do." I'm not much for that model because in my market, it doesn't leave enough to repair a house. If you're in a very expensive market, the ARV is $1 million. Okay, if I buy at 60% of ARV, I still have $400,000. I can still do a lot of work to the building, and there's still some room for profit. I can understand that model, but I don't utilize that model. The model I use for flips is the 65 to 75% model, usually 65, 2/3. If it's worth $100,000 when I'm done, all of my dollars in the entire process of the deal can be no more than $67,000. I have to buy it, fix it, hold it, sell it, pay the realtor, pay the transfer tax, pay everybody I can within that $67,000. And, I might be more like 73, but I've got to try to hold tight to that. And everyone says, "Oh my God, you want to make a 30% return." No, I don't. I, at the end of the day, want to make a 10 to 20% return. I need that other 10 to 20% for things like cost overruns, expenses that don't quite fit in the 67%. My utility bill was too high. I had to hold it for another 9 months. A lot of times you put your lender fee in there. So basically, you look at a property and say, okay, the middle comp from a realtor or from someone who knows what they're doing is $150,000. So bought, fixed, all boxed up, done, everybody paid. I need to put no more than $100,000 into that property if I'm going to sell it for $150,000. And you don't go to the top comp. You don't even go to the middle comp. You go a little bit below the middle, like 90% of the middle. So the top comp is 200, the bottom comp is 100. That's where I'm at 150, 140, whatever. So that was easy. You have to be all done for 2/3, and you have to think about everything. And as a wholesaler, I've had so many wholesalers say to me, well, I don't have those expenses. What do they matter to me? They matter to the person whose money you're hoping to get. You have to look at, and don't forget your lenders, your private lenders. Like we said in the last segment, you can make 10 to 12% as a private lender. Well, those of us who are flipping are the ones you're making that 10 to 12% off of. So, if you're going to spend $70,000, if you're going to borrow $70,000 from me, I want $80,000 back or something.
Yeah. And if you're paying them interest only and you're paying every month, you got to, so if you had that $100,000 at $833 a month.
Yeah, exactly.
You got to pay $833 every month. Do you want to hold this thing for 9 months?
Yep.
No, not on a $100,000 house.
Exactly. And you have to also be ready for, multiple exit strategies. Just my client and I did do three beautiful flips that were great. They're great houses. They came out really nice for this region. They didn't find buyers at a price that he found reasonable. It was all his money. He made all the decisions. It was his money, my time. I make half the profit, whatever. And we ended up renting him, and it worked okay because in our market, what his cost of money was, there was still some profit left over month to month. Okay, terrific. That's great. In a market where you're putting, you're buying something for 100, you're putting another 100 in. Okay, you've got a $250,000 mortgage on the other side of it, plus another $25,000 a year in taxes. Are you going to be renting that thing for $3,000 or $4,000 or $5,000 a month, enough to cover just break even? So you look at the multiple exit strategies and make sure that you're okay with any of the results, and that's why the 70% rule is important. Because at the end of the day, the one thing you never want to do is say to yourself or your lender, hey, let's try this again. I know we lost money last time. Let's try it again. It's not hard to say, I know we broke even last time, but we can do it better now. Let's try again.
Yep.
But if you lost money, are you going to get their confidence back to give you money again?
No.
So you have to watch that math carefully.
Yeah, the main thing when you borrow money is, my always thing is that we get their money back and everything we promise them. That's the most important thing to me before I make my own money. Because, that's just, you want to be that good person, You don't want to lie to the person. We're always up front. I mean, you're very conservative when it comes to, when we look at houses to flip,
Yeah, exactly.
You always add that extra 5 or 10,000. I'm always going a little lighter, and it's important, and I get it, and you're always right, so that's why I'm glad you're there with me.
Well, I'm not. I mean, I walk away from deals that other people then go in and do really well with, but for me, it is always the best deal done is the bad deal not done, and I would rather walk away. And also, but now when you flip to rentals, it gets a lot more complicated, and I shouldn't say a lot more complicated. The important things, okay, so with a rental, you always want to know the ARV. You always want to know what a comp's at. You want to know what your lender is going to say about it when you finally go to refinance. You're going to want to know all the stuff you want to know about a flip, taxes, insurance, utilities, But when you're evaluating the value of a rental on an income basis, there's two bases, the income basis and this comp basis. Comps are how does it compare to the market? And are we if the comps say the double is worth 150,000 and we're going to be 200,000 into the double, well, on a comp basis, we're making a huge mistake.
Mm-hmm.
But if the income basis says that, 11 units I have in Wilkes-Barre, Section 8, whatever, not the most pretty buildings in the world. If they comped out at all, they're going to comp out at about $300,000. No, I mean, they wouldn't comp, so it's kind of hard to say. But basically, looking at the income basis, they clear $70,000 a year between the two of them, $65,000-$70,000 a year. Most banks, our market is almost a 20 cap. Most banks are at a 10 cap. So according to the bank, this thing's worth $500,000-$700,000, depending on what cap rate they choose. Well, we're buying it for $360, so that's an easy one. Of course, we're going to take that deal. And the way we determine the income valuation is we start with what I call the AGI, the adjusted gross income, which is all of the incomes minus the hard expenses. What utilities the landlord pays, what taxes, what insurance, what sewer. Not maintenance, vacancy management. Those things are soft costs. They're important, but they're second. So let's say you get on these properties. So there is, $400,000 in income, $330,000 in expenses. There, I have an AGI of $70,000. I'm making up numbers, not really the deal. I have an AGI of $70,000. Our market is I started the offer at 17.5 cap rate. So 70,000 divided by 17.5, or sorry, 0.175. We're talking about percent. 70,000 divided by 17.5%. That was the offering price, $400 and something thousand. Now all of the buyers are coming in and saying, "Wait a second, you forgot about maintaining the building, managing the building, vacancy expenses, carrying costs, blah blah blah." Meaning the soft costs, like vacancy. Well, if you have no vacancy, you have no vacancy costs. Maintenance, so if nothing breaks, you have no maintenance costs, but you got to plan for it anyway. And so what I do is I take 15%, sometimes 30% of the rent. So that's another, in this case, let's say $20,000. So my 70 AGI minus my maintenance vacancy management, which I do
50.
off a percentage of gross rents, is 50. And now I'm taking 50 and I'm dividing it by the cap rate that I want to make. Say, I'll just use 10. We do better than that in this market, but it's easy. 50 divided by 10% is $500,000. That deal's worth $500,000. Now, the last piece of the puzzle for some people is the cash on cash return. Cap rate is your profit divided by the amount of total dollars in the deal. Whether it's bank money, your mother's money, your money, you stole it, wherever it came from, it's money in the deal. So if you're clearing 70 and you invested if you're clearing 70 and you invested 350, your cap rate is 20%. 70 over 350, 20%. Now, the bank picks up, and I'm going to go to easier numbers. The bank picks up, let's say it's a $100,000 deal, and the bank picks up 80%. So, and let's just say on a $100,000 deal, $2,000 or $20,000 a year profit. So 20 over 100, 20% cap rate. My cap rate's 20.
Mm-hmm.
And let's say from that 20, I'm just going to pick a number. I'm going to spend 10 of it in mortgage. And I'm going to have 20,000 of my own money. The bank will put in 80, I'll put in 20. So I'm going to put 10 in my pocket over the 20 that I took out of my pocket, which is my cash in the deal. So the cash I put in my pocket versus the cash I took out of my pocket, my cash on cash return, is 10,000 over 20,000. My cap rate's only 20%. My cash on cash return is 50%. Because the bank took the bank risked most of the money. That's why smart investors leverage. It also makes you less prone to liability, but you will make more per dollar. And that's whether you BRR strategy, whether you mortgage it up front, however you do it, that's the way you do it, basically. And so when you look at rentals, you've got to look at AGI and its cap rate. NOI, so AGI is hard cost minus hard expenses. NOI, which is after your maintenance vacancy management, and your hard costs over hard expenses, that's cap rate, and cash on cash return. And we have formulas and spreadsheets that we can help people with and everything that kind of walk you through it. But you have to know that, and you have to know the actual, what's it worth on the open market? What would a realtor be able to sell it for? Because you have to know what your bank is going to want to appraise it for, basically.
Yeah, especially if the next investor has to get a mortgage. You could ask whatever you want, but the bank's only they're just going to run the numbers. They're going to run the comps in the area,
And you also have to take into account, like this 11 unit deal, high cash flow. These buildings are in a unique little Section 8 kind of program, which has some benefits to it. But at the end of the day, I had a lot of people say, "Oh, I'm not doing Section 8. I don't want that audience." Well, I said, well, you can rent this building out normally. You could step out of the program and rent it out normally, but then you lose the benefits of what the program offers. But I said, for the most part, is you have to then look and say, okay, in this neighborhood, my regular tenants and my Section 8, first of all, I have no problem with Section 8 tenants. I've done very well by them. But, my regular tenants and my Section 8 tenants are the same. So you also have to decide if the property and the deal itself is the right one for you. We're getting a 20% cap rate on this property. But the owner is going to have to deal with the fact that, people who are on that level of the economic strata, when the smallest thing goes wrong in their life, everything goes wrong and they tend to just walk away. And so you might have a little more effort in you're going to make more money in a lower grade building, but you might have more effort to make that money. So you have to, so you have to balance everything in there and say, what's the right strategy for me? And again, if you're in a market, and I believe most of these appreciation markets, New York, Miami, all the places you can think of, they're going to have a problem because of COVID eating up the when the people's mortgages come due. So I don't believe the appreciation is going to continue for a while in those markets. But if you're in a market where you're appreciating really well, that might enter into your equation. You might take less on a rental value because the property is going to appreciate. If you've got a duplex on the beach, you might be willing to spend more that, you might be willing to suffer on your cap rate because that's going to appreciate more than a duplex in the inner city. But those become the soft questions. The hard questions are just do the math. And if the math doesn't work, my self-storage mentor told me, I was looking at a deal in Macon, Georgia, phenomenal math. It looked terrific. The owner would have basically given the place away. And he's like, yep, but look at what's been coming out about Macon, Georgia lately. And this is when some pretty nasty stuff was going on. He's like, you don't want to be anywhere near that market. He said, first of all, it's oversaturated, it's oversupplied. He said, but second of all these other problems that have been in the news, he's like, you're going to have trouble. He's like, the best deal done is the bad deal walked away from. So make sure you look at the whole picture. But if the numbers don't work, the other thing he said is that I had a deal that, they wanted $4 million for, and I could make my numbers work at $3 million. And I said to him, well, I can fix it so it'll be worth $4 million in a year. He said, yeah, but he said, you don't offer what it's worth then, you offer what it's worth now. You don't work on predictions. You work on actual.
That's great advice, Steve. That's all I can tell you on that. Absolutely. Just like that house we looked at the other day with that wholesaler, right?
Yeah.
He's making predictions,
Yep. And, that house is a great example because he was not looking, he kind of locked it in too high because he didn't do his numbers up front. He didn't know how to do his rehab numbers, and rehab numbers are key. Sure. Whether you're doing a rental or you're doing a flip, one of the things with the Section 8 building is tenants are living there. They are happy. Everything is fine. The building is producing money. But when the tenant that's been there for 20 years moves out, his place is a crap hole to any new person. He's fine with it. So there's deferred maintenance that has to be done. So I told all my buyers, look, you've got $70,000. You're buying this thing for $350. Over time, there's another $100,000 that you're going to pour into this building. So just have that in your numbers. Build that into your thing. If your cap rate says the building's worth $250,000 and there's $100,000 in work that needs to be done immediately or some sort of reasonable time frame, Like, the roof is 20 years old. Well, at some point soon, that roof's going to start dripping you. The building's not worth $250. The seller doesn't get $250. The building's worth $250. The seller gets $150 because there's $100,000 in work there. So being able to do your repair estimate, which this guy had no training, no experience in doing, and also he didn't know how to go to the owner and suggest creative strategies, suggest a subject to mortgage, suggest other alternatives that might bring the seller, because the seller owes more than, frankly, we could buy the house for.
Yep.
If you don't know your business, one of the reasons, I started teaching, if you don't know what your end buyer is going to do with the property, whether that's you or your wholesaler, and you don't know the costs they're going to face, then you can't properly analyze the deal. And if you don't take into account your repair expenses, and you pay that whole $250,000 that the spreadsheet tells you the property's worth, and then you start spending the other $100,000 that it needs, you're upside down. And my first building wasn't nearly that drastic, but after 4 or 5 years, my wife and I didn't know what we were doing. The realtor didn't know what we were doing. None of us were trained. We just read books, and the place was a loser from day one. We turned it around to where it was making a little bit of money, but I would never do that deal again. Well, that's because once we turned the key and got in the building, now all of the things we didn't notice start to come home to roost. When I walked through the building, it looked like it was a gorgeous flip. It looked gorgeous. What they did was they glued secondhand cabinets to the walls. They painted over problems. If you don't know what you're looking at, if you can't properly evaluate the expenses, if you don't take into account the repair expenses, it can hurt. You can correct from it. That building's one of my biggest cash cows now. But you have to take into account, and if you don't know we can help you a little bit, but if you don't know how to estimate the repairs, bring someone who does. Hire a contractor. Spend that $100.
It's
to
worth
have that contractor.
It's worth it all day long, $100.
Yeah.
Before you get in for 100,000, 200, 300, whatever you're going to get in for.
And, people say, oh my God, why do I want a building inspector? He won't even give me a price. I said, you're right, he won't. And I don't personally usually use them. But what the building inspector will do is he'll point out things the contractor's not going to see. He'll tell you if there are termites. All the building inspector's job is to say, I see evidence of termites. Have a professional look at that. I see evidence of, have a professional look at that. You bring your contractor through, which is mostly what I do, and he's not going to be looking for termites. He's not going to, he'll look, but he's not a pro in that. So it all depends where you're at, but you want that. If you don't know it, you need to find someone that knows it. Don't trust the seller. Don't trust other parties.
The wholesaler. We don't trust anybody but ourselves.
Well, and I go through properties all the time, and my clients say to me, hey, is that asbestos wrapped around the pipe? I say, well, it's a white insulating substance from around the 60s. Is it asbestos? I don't know. If you're concerned, have somebody look at it. How'd you do that furnace? I said, well, I've had really good luck with old steam furnaces continuing to work. However, if you're concerned about it, have it looked at. Well, do you think it'll be fine? I said, do I think? That's not the answer you want. You want the answer that's right. And, is it asbestos? 90% of the time, that crap around the pipe's asbestos. Does it need to be remediated is the next question. Does it need to be removed? So if you don't know, and the seller, you and I do this all the time, say to the seller, hey, listen, what's the age of the systems? Well, I did the roof, I don't know, a couple of years ago. I think Carter was president.
Yeah. Yeah. Well, I just updated my kitchen. Oh, nice. And we get there, and when? 1973. Great.
Yeah. Yeah. So basically, and they're not trying to be anything. They're just, that's their memory.
Yeah. You've been in the house that whole time. So do you. It's an updated kitchen from what it last was. So yeah. Time doesn't mean anything to them at that point. It means to us when we're buying to flip it, wholesale it, or whatever, whatever factors we're going to use on this house. But yeah, it happens all the time, Steve.
Yeah, exactly. So basically, you just have to analyze. You just have to be careful in your analysis. Yeah. And unfortunately, I kind of lost what the question was, but I think that kind of covers the sort of the value analysis.
Mike, he just wanted to know how do you know if a property is a good deal quickly, and about an in-depth evaluation, which you told him, and what kind of return on investment do you think is worth doing? And it all depends on the person, really. But
right, ROI totally depends on person. It also depends on whether you want cash on cash, whether you're doing cap rate, or as one of my client appreciation. And one of my clients, like I'm always talking cap rates or whatever. He's like, stop saying cap rate. He's like, how many dollars a month am I putting in my wallet?
Yep.
So he doesn't want to know cash on cash percentage. We use that as sort of a conversation piece. But he's like, you know what? If I'm not putting $200, $150 to $200 a month in my pocket after everything, don't even bother me. Don't even dial me up. And that is what everyone has to decide. For me, if I'm not putting around that $100 to $200 in my pocket every month per unit, forget it.
I wouldn't even bother.
To me, if I'm not putting 50 to 10, minimum 10, more like 12 to 18% cap rate based on either NOI or AGI, don't even bother. On the NOI, it might be 12, it might be 6, it might be 14, 16 on the AGI. Don't even bother. If it's a single digit, now.
Steve, can you speak up a little bit?
Sorry. If I'm not putting 12 to 14% cap rate, I'm not bothering.
Well, you're a greedy guy.
Yeah. Now, if that's usually the AGI number, not the NOI, but also it all depends on the sector. If you're buying a storefront, a strip mall type commercial, you might be doing 5, 6, 7% cap. If you're buying certain other sectors, you might only be doing 8, 9, 10, kind of cap. And this is Northeastern Pennsylvania numbers. But I look at people who make investments, and they do extremely well. They are extremely wealthy people. There's no question, because percentage only gets you so far. If 2% is $1 million a year, in actual value, it's still $1 million a year.
Yep.
But, you have to also say, okay, in what sector am I investing in? If you want to, self-storage is typically a 9 to 18% cap rate, almost nationwide. Usually 9 to 11 usually. But it's also a very passive investment. You're not getting the 2 a.m. furnace calls probably. So you might take a lower cap rate from that than you would from something else. Or you might say, you know what? I live in New York City, I live in Miami, and I can pick up a piece of land from my mother, and I just know, when my kids graduate college, that piece of land is going to be worth more. That's a whole nother game. Fitting appreciation into a cash flow strategy is very speculative. It's not something I have a lot of experience with. People do it.
Yeah, because we really don't have that in this, the area that we're dealing with personally.
Yeah, for me, I would have to say that, it's got to be 12, 14, 16%, or I'm not going to get out of bed for it.
Yep.
Even in the seller's market we currently have here in Northeastern Pennsylvania, the first seller's market, everybody, so the first seller's market ever, it's still 12, 14, 16, 18 cap. It's still a very high cap rate. So, it's very hard for me to look at something. Somebody says, oh, I can make, I'm on Facebook all the time. People are, buying duplexes for $1 million, and gee, we're going to make $4,000. We're going to net, $4,000 a month. And I'm like, well, that's great. $4,000 is not a bad number to net, except
$1 million.
I could get you a lot more for $1 million. Literally, I'm signing a contract today for a client, $363,000, and they're going to clear $63,000 a year before maintenance vacancy management. So they're going to make more than that $4,000 on less than half of that money.
Yep, maybe a third, Steve, a third. That's crazy.
Yeah, pretty close. Pretty close, yeah. So I mean, basically, it depends on the person. It depends on your situation. Now, the last jump in that to make is where the money comes from and what the money is. If the money, okay, because if you're using retirement funds, self-directed IRA, self-directed 401k, talk to your advisor. There's some landmines there, but it's what I do. I either have to buy something for cash. The reason I lend is because I don't really want to own things in that, but I either have to buy something for cash or I have to get a non-recourse mortgage. Well, I'm probably going to make less running an ownership through my retirement fund because of non-recourse mortgages and some other things. But I don't care because I'm just shy of 50. I turned 50 in January. I got 9 to 12 years before I'm even allowed to touch that money. So if it only grows at, 8, 9%, okay, that's 90% in 10 years. I'm doing okay.
Yes, you are.
And, whereas for, my terrestrial money investments, I've got to make more because I need to eat that money. So it depends on things like that. It depends on, if you've got a 1031 exchange and you just have to place this $1 million because you did a 1031 exchange. I tried to help a client last year. He came to me too late, but we couldn't beat the calendar. But, he's like, I have this many millions of dollars. I need to place it in this quickly. I need to close this quickly in order to avoid the capital gains tax. I don't care as long as it's above a 4 cap. I don't care. Because anything, even breaking even, which is basically a 4 cap, cost of living is 3 something. Anything is better than paying the IRS 40% of his profits. So there are exceptions to the rule, but on basis, 12, 14, 16% cap, or 40 to 60% cash on cash, maybe 30% on the low end.
So I guess that's it, Steve, right? We want to wrap this one up this time?
Yeah.
We've been talking for a while.
I think that's it.
Yeah. So, hey, thank you, Steve. And if anyone has any questions for me and Steve, reach out to us and make sure you use the REIPOST.com and the RECN, Real Estate Community Network.us. Go check us out today. You can always reach out to me and Steve. And if you have any questions, also reach out to us. That's it, right, Steve?
Yep, I think we're good.
Okay. Talk to you guys soon.
Thanks for listening to the REIPOST.com podcast with Mike and Steve. Whether you need to buy, sell, find information, products, software, calculators, funding for a deal, or even find a mentor, start your search today at the REIPOST.com. It's free, so now start using it to your advantage.